Computer. Okay, so today is July 6th, 2023, 1:24 p.m. So I'm here with Mark talking about our first session, talking about what really makes it a successful trader. So look at trading as like a stool. The stool, typical stool, has three legs, sometimes four, but let's call it three. At least three legs for it to stand. So basically, all three need to work together for you to be able to sit down and not fall down, right? Would you agree?
Yes, I agree.
Okay. So basically, we cannot have one and not the other. Now, the first leg is the methodology. But I'm just gonna really come back to this later. I'm gonna go back to the third leg first because I think the third leg, a lot of people, including myself, I started learning about trading psychology until when I say late in the game, later on. I was used trading. Really, I have no clue what trading psychology was and how important it is. Because without that, you're gonna be in for a lot of trouble. Then you're gonna realize, okay, why cannot I make money? Because your psychology is not on point. So I think this really should be the first. I'm gonna reverse this and make it the first leg. But I didn't have a chance to do that yet. So I'm gonna just look at it at first. The first leg is trading psychology. The first thing you gotta realize it's why am I trading? Why? And really that's everything else that you do. Could be a job, could be a relationship, it could be a business, and trading is a business, by the way. A lot of people look at trading as a gamble or as a side thing. They do it like wishy-washy and they expect results. I mean, all those things I'm talking about here, I'm talking about me. That's how I used to be at one point. Okay, so that's why I used to be at one point. Trading is a business, so that's why you gotta have a plan. That's why we're gonna talk about trading plan a little bit. But you gotta know your why. Are you trading for excitement? Are you trading to just make a little bit of side money? Are you trading to replace your income now? Are you trading to be wealthy? Are you trading to get to a point where you can really expand it and have even get to a point where you can train other people and really have a team of traders with you? That's what a hedge fund is. Basically, it's a team of traders trading somebody's money, and they because it's the word hedge is basically you protecting yourself. If I got 20 traders trading, all of them may not go crazy at the same time. At least I'm hoping that. you know. So some of them are gonna make money today. As long as most of them, or at least whoever make more money than what they lose, the hedge fund will be profitable. So you gotta know what your why is. So can you tell me a bit again about your why? Why do you want to trade?
I just want financial freedom. I would like to leave my job and kind of focus on, on what I do best, which is movies and acquisitions.
Okay.
I think on that sheet that I told you that I'm looking to purchase my first company, that probably won't be legal things strong. And I'm just looking to have that financial freedom that that's my name to be able to kind of do it when I want to do it and not just be stuck in between the time range from Monday to Friday.
Yeah. So all those are very, very noble and really legitimate reasons to want to be a trader because when it comes to financial freedom, not only the amount of money you can make is great, but it's how you can make it.
Yeah.
You don't have to be tied up to a desk. You can be on a beach and really trade.
Yes.
As a matter of fact, I'm gonna give you an example. I remember one time I went on a vacation with my family. At the time, that was the biggest trade I ever made as far as profit. Typically, at that time, I was trading mainly forex. And at 3 a.m., sometimes I would get up to look at the market. And then I got up about that time and I went and used the bathroom. And then I'm like, oh, I have my laptop here. Let me look at what the market is doing. I took a trade. And went back to sleep. When I wake up, that trade paid off for the vacation and then some.
Wow. That's what I'm talking about.
So trading really, you have that freedom. You have that ability not only to make a lot of money, but also flexibility. There's bar none. And one of the people that I follow, I mean, his name is, he's like a mentor from a distance. His name is Oliver Velez. You can look him up on YouTube. He said trading, you hear about real estate investment, you hear about all kind of things. Trading is like the last frontier when it comes to equal opportunity. Because Mark, when I have my order in the market, they're not gonna say this guy's social status is this, so I'm not gonna fill that order. I'm gonna fill somebody that has a better social status.
Yeah.
Or this guy account only have 50,000. This guy's 5 million. I'm gonna fulfill that. As long as you're in line, you just a number. You just bits. You just zeros and ones. That's all you are. If my order get in front of Warren Buffett, guess what? My order is gonna be executed before Warren Buffett if I was in line before him. So trading is the last frontier when it comes to equal opportunity. Because if I'm doing real estate, somebody may not want to deal with me because of my color, because of my whatever, and they may not want to deal with me because for whatever reason. But trading, if I have my order in the market, it's gonna get filled, and it's gonna get filled like everybody else's order. Mm-hmm. So, it's really that simple. Now you establish why you want to trade financial freedom. You want to leave your job, which is great. That gives you a why, because you gotta have a strong why. Anything that you do, you gotta have a strong why, because there's gonna be down days, there's gonna be down weeks and down months and difficult days. There's gonna be days you do everything right, but you still don't get the result that you're looking for. The market come back and tag you out for one tick, and then it goes your way. You can have some of those frustrating days. It will happen. I'm just preparing you for those. So now, also, what's important when you start trading, a lot of times people look at trading, there's a lot of money in the market. Now, what's your relationship with money? That's very, very important, because a lot of people just hate money. They hate money. But I'm not asking you to love money, but you gotta value money. And everything I'm talking about here, that was me at one point. I used to trade. Let me get this thing in here. I used to trade, right? My account was like this. I make money and I give it back. Because at one point I didn't think I was worthy of all that money. You gotta have a good self-worth. Okay. Your self-worth, you gotta know, hey, I deserve this. Self-worth is important for you to be a successful trader. We're not asking you to love money, because actually the Bible says the love of money will evil. But you gotta value it. That same Bible says, hey, money is the answer to all things. Mm-hmm. You gotta have a strong self-worth. That's why you want to start slow, then you build that. You don't want to start with 20 accounts. I had a guy that I was trying to help, but every time you get 20 accounts, you blow it. To the evaluation, I said, man, start slower. Or when you're trading, trade smaller sizes. But he wasn't. So, after, at the end of the day, I'm just, okay, that's what you want to do. That's what you want to do. So you got to have the self-worth. Now, you got to know yourself too. What are my strengths? What are my weaknesses? After a while, I realized, man, every time I'm up, I give the money back. So what do I need to do? I need to find a way to stop trading. Whether it's a losing day, or winning day, you have to have it cut off. Yeah. It's like a circuit breaker. You got to cut it off. Somebody equate trading almost like you're in a big casino. So eventually, if you don't got that cut off, you're gonna give the money back. I've heard many stories. I'm gonna give you a story real quick that somebody was telling me. Someone was playing blackjack. They came in with $10,000, and by the time they, after 2, 3, 4 hours, they were up maybe about 100 grand, and they gave it all back, almost all back, and they went it back again, 150. They gave it all back. They went home with $0 because they didn't know how to.
That's what I did. You know, trading.
Mm-hmm.
I made 2 days in a row. I made pretty good money, and then the time that I knew get out of that training, I wanted to, it was my must really.
Yeah.
I'm gonna go ahead and make more money. Instead of selling with this 2,700,
Mm-hmm.
trying to get up to 5,000. That's what I had. And when I got the first time, I thought this would be like 20,000. I think maybe 96,000. 25. Right? So next, maybe in about 10 more minutes, I thought I could make that loss.
That's revenge trading right there.
Lost more money. And then on the third try, same thing. Trying about 20 minutes later.
Because you know what? At that time, your logical brain is shut off. It's your emotional brain that take over.
Okay.
Yeah, that's what it is. Trading psychology is very, very important. That's why you can have the best system. I told you that. I think I mentioned this before. You can have the best system, and you actually, I'm gonna give you because this is so important to understand how your brain works. Give me a second here. I'm looking up something. I think I'm gonna put that as a. I'm gonna do like a resource folder for you. So one of them, I'm gonna have this book in there. It's a book called Mindful Trading, I think.
Okay.
Yeah, Mindful Trading. It's I'm gonna give you a PDF for that. That's things I'm just gonna throw in there as we go along that I think that can help you because it is really important to understand your mind is your most important thing that you can do in trading. It's not the indicators. It's not all those are tools. If you gotta be in a state. You gotta have a flow state that realize you know what I gotta shut off my animal brain. Because think about it, every time that you do something that you're not supposed to do, that means your animal brain took over. And trading is one of those things that your brain, the animal brain doesn't understand that it's just a trade. It thinks if you know losing trade, if you listen to animal brain, you think you're gonna die.
Right.
Remember, years ago, the people used to think, oh, behind that bush, there's a saber-toothed tiger that's gonna kill me. So fear, that's something that's kind of ingrained in the way we are built. And when you're trading with fear of losing, fear of missing out, we call that FOMO. If you're trading with FOMO, if you think like, I have to get in this trade, please get away from the computer. But you got to train your brain to know that FOMO, fear of missing out. I got to make this
Yeah,
back. Revenge trading,
that's what I was thinking.
making it back, revenge trading, that's gonna kill you because what you know why? One of the reasons that revenge trading doesn't work because you're not getting in the trade based on your plan. Nobody goes into the market thinking I'm gonna just revenge trading. Nobody can do this. I'm just gonna no. At that time, you throw your plans away. Now it's just your animal brain taking over. It's your animal brain so you gotta know your strengths or weaknesses. One guy that I know one time said, when I started to be, he said when I started to become successful with trading, in order for me not to mess it up, I had to invent. He said I had to reinvent my life. Sitting all day long in front of the computer trying to make money all day is gonna backfire. So what he had to do, he had to join a gym. He joined a gym. He had to do some other activities. Trading is very, very can be very lucrative, but you gotta manage the time, your screen time. If you spend 4 hours and that's what 40 minutes, usually the guy that spent 40 minutes in front of the trading screen, we're gonna make more money because it's gonna be more selective. If there's nothing there, it's gonna walk away. Because when you have a hammer, everything looks like a nail. I'm looking at the market and I'm looking for a trade. When I'm looking at the market, I'm not looking for a trade. I'm looking if there's an opportunity. Because if I'm looking for a trade, before I know it, I'm going to get into a trade and I didn't even mean to get into that trade. Again, Mark, I'm telling you everything that I went through over the last 16, 17 years. If I'm looking for a trade, I'm going to find one. I'm looking for a clear opportunity. And even then, that doesn't mean it's going to be a success. It could be a loss. As long as I properly size my trade, I don't lose everything at once. Basically, when you're trading your whole, I'm gonna go on that on more detail, but everything that you're doing on trading today, I'm trading for tomorrow. I'm trading so I can trade again tomorrow because the market is gonna be there tomorrow. Okay. And also, when you look at trading, you gotta look at it in terms of probabilities. You gotta look at it in terms of probabilities. So you gotta ask yourself, what is the probability of this trade to work out? If it's a low probability trade, you stay away from it. Some low probability trades will work out fine, but you gotta put the odds in your favor. You gotta put the odds in your favor. If the market if it's a down day today, I'm gonna try to look for opportunity to go short. Now, when I go short, that's gonna be that the timing in trading is everything. That's why we got a saying in trading: bulls make money. I can open a chart today and any chart today. I can tell you some people bought, they make money. Some people sold, they make money. Bulls make money. Bears make money. Hogs get slaughtered. All you gotta do, you can be a bull if you want. That's fine. In a down market, because there's gonna be some retracement. I can buy the retracement. That's a counter trend. It's a little more risky. Yes. I can be a bear. That's fine. Even in the market that's going up, there's gonna be some profit taking. But don't be a hog. Hog meaning, hey, I want more money. I'm just gonna hold on to this. And before you know it, my buy position that I was in, now it's at zero, or I'm losing money on it. So you gotta know when to hold it. You hear that term all the time. You gotta know when to hold them and when to fold them. And another thing in trading, there's no room for ego. Because remember, there's nothing you're gonna do to make the market move or to make the market go your way. All you're trying to do is executing a plan based on what the big boys most likely to do. If they do it, and sometimes they fake you out, you know? That's why breakout trading is works about 20, 10 to 20% of the time. So I'm not a breakout trader, but when there's a breakout, I can identify if it's a real one, or if it's a not, it's a fake one. Not 100%, but there's tools you can use. Say, okay, is there any volume in here? What kind of environment are we in? Are we in a bullish environment today? Are we like in a risk-on environment, which is bullish? People want to buy equities. People will feel good about the market. Or the job numbers that came out and they weren't good, so people may want to sell the market. So basically, you don't. I used to come to the market and say, I want to just buy, just go up. No, I can't do that. You gotta do what the market gives you. And also, when it comes to if the market, let's say this is the range. I'm gonna do that the different color. Let's say the range of the market is this. Okay, this line is the range of the market, and this is a down day. If I sell right here, the market is right here, and I sell. I cannot put my target over here. If I put my target over here, that's wishful thinking. I cannot put my target down here. That's wishful thinking. I gotta put my target somewhere in that range because the ATR will tell me over the last 2 weeks or the last two months, this is what this market has been doing. So the ATR is a powerful tool to give you a realistic target and stops. If I sell down here, I'm kind of late in the game. Again, because I want 10 points, if this is only 8 points, I'm just gonna take the 8 points or six, maybe six of it, you know? So you don't wanna try to get everything. I used to try to get the whole move. I don't do that anymore. So there's no ego. Understand that it's not me that's moving the market. And last but not least, the market is always right. You got to accept that you are wrong. And that's why you got a stop loss. The stop loss is for saying, hey, I'm wrong. You admit that I'm wrong. You got to be able to admit that I'm wrong. That's why the ego will kill you in trading. Stop loss say, hey, it could be I'm wrong, really wrong, or I was wrong, because sometimes what happens is the market's going up, 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 and you go long, you buy right here, then it come back down and tag you out. Your stop is down here and tag you and go back up. So that means my stop that was here, my stop loss got taken out, but I wasn't really fully wrong. But because of my stop was over here now, I'm wrong. This is what basically this is how much I was willing to lose. So that's why when you're placing your stop, it's important place them at a way that they may not get it, or give you a wider stop. For you to use a wider stop, you gotta trade smaller contracts, smaller size. Any questions so far about what I talked about here?
Most of that stuff that you went over, that's all stuff.
Yeah.
When I was
Again, as a
trading,
mhm.
I was doing like short moves, just like short moves, and I actually made money on it. Then, got an indication that hey, this market is going to do well. And I got into a short position, and then that's when the small song really was true. As you said, it's trying to capture the entire move up to the top.
Yeah, picking
Thing
tops
about
and bottoms.
Yeah,
Picking
and
picking
thing
tops and
about it
bottoms out.
is, the thing about it too is, they when we buy 10 contracts at a certain price, obviously, the big boys are going to try to stop and just basically, so
Yeah, and also 10 contracts is all relative. If I got $1 million account, 10 contracts is a very small size. But if I have a $50,000 account, and based on the rules that Apex give you, 10 contracts is too much. It's way too much. Even though they allow you to fit. That's another thing. Because they allow you to trade 10 contracts, that's on the 50K. The 50K account, you can trade up to 10 contracts. That doesn't mean you should. You should really do one or two or three, maybe. Depends on if you're trading, let's say, something that's not as volatile as the Nasdaq. Let's say you're trading the YM, or you're trading. It's really based on where you're gonna put your stop. That's gonna determine the amount of contract you trade. And you can go down to micros. I talk about micros too. You may not even be able to trade one contract. So what you do, you trade macros. You trade 5 macros. You can trade 5 macros, which is half of a contract. So in that, let's trade for the ES, 5 macros, it'll be 625 a tick instead of 1225. Okay, versus 1225. So you gotta be able to, this is what 5 macros will give you. Give you more flexibility. You can scale in and out. You can do other things than just trying to be all in and out. So I'm gonna clear this board and we're gonna go to the next slide if you don't have any more questions. If you don't have questions about this.
No.
Really, that's why we're gonna talk about today, those 3 legs, because it is very, very fundamental that you understand those. And I would definitely recommend you watch this a few times. And so I'm gonna make myself a note. I'm gonna send you that book about trading psychology trading. Okay. So we clear that. So what about so we're gonna go to the second leg. Again, psychology needs to be in place. We're gonna go to the second leg, which is the first leg. Again, I'm gonna change that. But this is the second leg. Methodology. After you know everything that I just talked about, why you trading, understand your strengths and weaknesses, understand that, hey, I gotta come into the market, look at it from a probability point of view, not a because a lot of times people look at the market from a possibility vantage point. Everything is possible in the market, but I just want to look what's probable. What is probable right now? That's really what I'm trying to understand. Now, methodology, a lot of time people come in and say, hey, no, why is the indicator say this and that? Let me just click on here, click on that. If I click on this and click on that, I'm going to make money. Or this indicator turned green, that means I got to buy. Without even understanding what's really moving the market. What's moving the market, it's really the fundamentals. You got to look at if you're trading the ES, you got to look at, okay, what's the overall sentiment is. A lot of times people do fundamental analysis, technical analysis, but then actually I'm going to add sentiment in here. You got to do sentiment analysis. So I got to look at, for example, I'm just going to give you a live example. If I go to Market Watch, I'm going to put it on the screen. I got to look at Asia. So I'm trading in the morning. I got to look at Asia. How did Asia do? Wow. By the time I start trading, I have all those numbers. Asia was really red. We know today, most likely, it's going to be a red day. Then you want to find out why Asia was red. Can read up on all those things. Then you look at Europe. Europe is red. The market is very interconnected. Now, when I click on US, it's going to be red too, and it's not a surprise to me. Today we had a high probability to be a red day. That's why earlier when we trade that, what we did, let's go back to that. If you remember, the trade that we took today was a short trade. So right now the market is kind of in between the initial balance. It's kind of vacillating, going back and forth. But all this, you know what this is? This is called profit taking. You're taking profit right here. From this area, they're taking profit and they're going back. They're going back up. This is not an up move. You could have made money if you buy here, but you got to understand the context. The context is we're taking profit. As a matter of fact, if I were to do anything here, because this is a resistance area, hey, in the market you sell. I'm just gonna do this as an example here. You would sell. This is a sell area. Is it gonna go down? I don't know. We'll find out in a few minutes. But going back to what I said, analysis is very important. Usually, what happens is the technicals, when you see, for example, there's a trend line break, there's something that happened technically. There's a fundamental event people are looking for to fuel that. So if I go back here, there's some chart patterns that happen. You're like, wow, this is why this market went down. This is not why the market went down. The market went down. There's people that wanted to sell the market, and when this happened, that kind of accelerated. See that little trend line right here? It broke, then it started to go down. Now we're gonna do another trend line. It broke right here. Keep going down. It never went back or above the trend line. That's another trend line. So you gotta look, okay, what's the sentiment and what are my signs to get in? That was a sign to get in right here. What time was it? 8 o'clock. I would probably never get in at 8 o'clock this morning because there was news a few minutes later. But as you can see, what time this is about 11:30. Remember I said 11:30 is the time in the market that people trying to square up the position. Meaning they're right here. They say, okay, you know what? We made enough money. We've been selling since Asia. We've been selling since Europe. Now I want to be able to just make some of my money. Actually, I'm gonna realize my gains by buying back the position. When you sell, you gotta buy it back. That's what's happening here. This is the bottom. Now they went back to this area of interest. Some people are trying to buy right now, which it can go up or it can go down. I don't know. A lot of people are buying right now because it's squaring up. It's this market cannot go any further down. Now, if you look at there's another pattern here. There's a trend line right here. After a while, you're gonna see all those things, Mark. It takes a trained eye to see certain things in the market. So after a while, through the homework I'm gonna give you and things like that, identify trend line breaks, identify different patterns that we're gonna go over. That was a trend line break right here. Buying here was a nice buy and go to the next congestion area. That area before this happened, we knew this area was gonna be an area of interest. That's why they are right now. So they may break it up or they can come right back down. So again, this was an example showing, hey, you know what, if I were to trade here, say I'm gonna sell this market right here because this is an area of interest. The market kind of flip right here. And if I go back, look at that thing I just said. You're gonna see at one point that area was an area of interest. Let's go back. I don't know. Oh, I only have five days on it. Let me add more days. Let me add 10 more days on this. All right. So if I go back, if I scroll all the way back here, you're gonna see at some point there was some interest in this area. See that? This is June 30th. There was some interaction with that zone. At some point it was a resistance, then it becomes support. Let's see if we get more interaction with that zone. So you gotta understand the technicals are important, the chart patterns and the volume and all that. But first and foremost, you gotta understand, okay, what kind of environment are we in? Are we in a bullish environment? Are we in a bearish environment? What are the sentiments? A lot of times you're gonna see news come out. The news is negative, but the market goes up, and you may ask yourself why. Why do you think that happened?
You want to buy why the news is cheap.
Yeah, that's part of it. That's part of it. Yeah, that's a good
Yeah,
answer.
you can buy.
Also, part of it too is the fact that those people, market is always looking for value. So what you just said kind of, goes along with that. They're looking for value. That's all the market cares about. Okay, is it cheap? Is it expensive? If it's expensive, I'm gonna sell it. If it's I'm gonna sell. If it's cheap, I'm gonna buy. Because the market always looking for value. So the technicals are important. Talk about chart patterns and things like that, and volume analysis and chat patterns and all those things are important. Fundamentals, you gotta understand that. Okay, if this number come out more than expected, this most likely is gonna happen with the market. Let's say you got unemployment. Unemployment comes out, there was more jobs created. Wow, we may get a good boost for that day. And also, you gotta look at the overall picture of the market too, because sometimes people just look at that day. If I'm in a bullish cycle, I may have a bearish day. I may have a day that the market goes down. That doesn't mean I should be trying to look for sales all the time. So some people look at the daily chart. I don't. I look at the daily chart for the bigger context, but I really look at the 1 hour and the 4 hour chart. Like right now, if I'm looking at the 1 hour chart, I'm gonna move it over here. This is the ES. If I'm looking at the 1 hour chart, I can see that this market is going down. But the last 3 hours, it went up. Why? Because people are buying back their position that they sell right here. Because some breakout traders, see that range right here? Let me clear this so we can clear all this. So we can see what I'm talking about. See, there's a range that happened here. Some people put the order to go short right here. This cell right here. And then 44.25, that's a key number. Anything that ends with a 5 or a 0 is a key number. But usually the quarters, 25, 50, 75, and of course the 00. The 425 was definitely a number that people were gonna try to buy from and exit the sell position. So that move here, it's not It's not a coincidence. Some breakout traders got in here and they buying the position back. So that's why we got the last 3 hours, which is about 11 o'clock, starting to 11 o'clock or so, they're starting to square the position. They're going to lunch. They made their money for the day. They're getting out of the market. How did they get out of the market from a sell? They buy. So that's a 1 hour chart. Now, if we look at, I'm gonna open this. This is the 4 hour chart. 4 hour. The 4 hour tells me a while ago that hey, today could have been in a position where we're going short. Why? We have a trend line that broke here to here. There's a trend line that broke with that big blue candle. Then they retested, and also we had what you would call here a stop run. Because see how this candle here. Let me move this out the way so you can see it. I'm gonna show you with this here. This candle is just a little higher than this one. So why they do that? They break this by a few ticks. So people that are breakout traders can say, hey, I'm gonna put my buy stop right here, thinking it's gonna go up, then they reverse it on them. Okay? So all that you gotta take into consideration on the big picture. And then when the market is going up, 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 you gotta breathe too. Today could be just a retracement day. The last couple of days been like retracement days. How would I know where the market is gonna stop? I don't know that, but I can say to myself, okay, let me throw a fib on. Again, this is just technical analysis we're doing here. I'm just giving you an example what technical analysis look like. So I can say, let me throw a fib on and see where the market may stop and come back up. Where are we? We're at the 50%. We're between the 50 and the 61.8. Okay, the 61.8 right here, and this is the 50%. So we can see why the market might be bouncing in this area. They're banking some profits from that leg up. Nothing that goes up doesn't. You have to come down at some point. So really, when I'm thinking about this, long term, this market is bullish. Right, the last few weeks, we've been seeing bullish movement. Look at this. This is a bullish market. But today, you gotta look at the context. The context, hey, we're gonna go down. We're gonna go down. And on top of that, I can look at this. If I'm looking at my supply and demand zone, which is I'm gonna teach you how to place those. Supply and demand zone tells me if I do, let's say I don't know what happened today. If I start here, way back when, if I'm putting my zones on, I'll put a zone right here. I'm gonna put a zone. I can copy. The thing is, what object you have with Ninja, you can copy and paste it. So I can put several zones in and just move them where I want them to be. There's a zone right here. That was a demand zone. And what makes it a demand zone or supply zone is what the market does at that zone. If it goes up, that was a demand zone. If it goes down, that was supply zone. So all those zones right here, I can tell you, everybody has those put in there. Because right here, before this happened 2 or 3 days ago, I already know this zone was going to be a zone where we're going to have some selling. But this happened before, it may happen again. That doesn't mean it's going to happen. But what they did, they break the zone for a little bit and they come back down. Now, right now, they're in that zone that I placed over here. Remember, I didn't know this was already there a few weeks ago, like 2 weeks ago, 3 weeks ago. That's June 14. See that down here? It's June 14. I could have had that zone in June 14. And today, July 6th, the market has a memory. Why the market has a memory? Because people trade the market. Even though we have robots and things like that, those are programmed by people. So the market says, hey, whatever came before as a resistance, this is a resistance right here. Market hit it, it came back down hard. Then he broke it, went to the next resistance zone, came back down, come back, just a lot of consolidation here, went back down. So we know this has the potential to become support. And that's what it's doing right now. So tomorrow, based on what's happened overnight, this market looks like it wants to go higher now again. You want to resume that because you got the fib. That's why you got to look at the market from a different angle. You got the fib at 61.8. Between that zone, this is a sweet spot right here. So you may say, how do I know? I don't know if the market's going to go. I just got to wait tomorrow and see what happens. So I don't know what's going to happen. I just know, hey, this is what's happening now. And I just got to do it. So fundamental technical analysis is important. We're going to learn all that. Trading system. This is when you start, after you know all those little things, then you say, hey, I'm going to come up with a system. A system is basically a set of strategies that you put together to say, I want to see, you may say to yourself, I want to see A, B, C, D happen before I take a trade. Then the trading system is going to incorporate into a trading plan. Not only the trading plan going to give you entries, the trading plan going to give you entries, it's going to give you an exit, okay? And it's going to give you money management. You know, like how am I going to enter that? Am I going to do 2 contracts? Am I going to do 3 contracts? Am I, all those things, am I going to vary based on my stop size? I got to get a pen for this, but I'm doing this with my mouse. So that's what the trading plan is designed for. Until you have a trading plan established, you really shouldn't be trading. I'm telling you from experience. But as people just come in the market, they want to click. Oh, let me just click here. Buy. It's like Kramer. Buy. Sell. So you don't want to do that. You got to have a trading plan. Now, what's the next step? After you have the psychology, any questions so far about this?
Going back to the charts that you show, like that point of consolidation.
Yeah,
right?
this is this is an overview of everything. We're not gonna go into details. Today is just like a 10,000-foot view.
Okay.
I was telling you what is considered to be technicals. The technical is saying, hey, this market may be bouncing,
Okay. No, I don't have any questions.
Yeah, because also technicals, it's really based on, it's on a case by case basis. There's no full proof. There's no full proof of anything. So what happened before, that doesn't mean it's gonna happen again. It may happen. We don't know. Because every day in the market, that's another thing that's fundamentally that we got to understand. Every day in the market is really unique. Every day is unique because the reason why you got different participants at any time. You got people have different motives in the market at any time. They can change their mind at any time. So a lot of things you can control. All you can control is where you get in. And when you get in and get out, it's not always something you can control. If there's slippage, if there's the market's moving too fast, you may not even get the price that you wanted. Trading plan is very, very important. You gotta have the trading plan, trade your plan. Plan your trade and trade your plan. You hear that as almost like like a cliche, but it's really important to do that. Because once you deviate from that, it's sort of recipe for disaster. Third leg, really, we're talking about psychology. How are you gonna do it? Technical now, risk management. Oh, that's very paramount because everything you're gonna see is kind of like a big circle. Everything touches each other. Because if I don't have my psychology right, even if I have the best psychology, the best methodology, it's not gonna work. And my risk management, if I don't have that right, it's gonna affect my psychology. It's gonna affect my methodology. Even my methodology might be right. It's gonna affect everything that touches. That's why everything is connected when it comes to. Let me see here. Clear all drawings. Everything is connected. Everything is connected. So basically, we talk about psychology. Okay, it's connected to your risk management. I'm gonna call it RM. Then that's gonna help you, even though you have the methodology, that's gonna help you execute your methodology right. Because if you have the right psychology, the right management, executing this will be a breeze. So if you don't execute this right, it's gonna affect your psychology. It's gonna affect your risk management. You see how everything is like a big cycle. You hear me? Are you there?
Yeah, one works off the other.
Yeah, everything touches.
Yeah.
Everything touches each other. So that's why you got all to be right for you to be successful over the long run. Now, how are we gonna approach risk management and money management? It's really say, hey, am I gonna just every time trade the one lot size, one fixed lot size? Is it gonna be 1 or 2 or 3 contracts every time? Or am I gonna base that on the percentage of my account? Which is the better way to do it? This is my preferred way. Okay. As your account grow, you can grow your size. This is a better way. But everybody has their own way of doing things that works better for me. And also, how am I going to determine my size? Is it going to be fixed again, or is it percentage based, or is it going to be based on my stop? So if I have a 10-tick stop, I may be able to trade 2 contracts. Okay, this is together here. If I have a 20-tick stop on that same base, everything else is equal. Now I can make paper trade with 1 contract. 10-tick stop, 2 contracts. Meaning, in this particular case, you're looking at 200. Let's say $250 is the most I can risk per trade based on my risk management. That'll be $250 right here. Okay, or I can raise the same 250. This is 250 also, but for me to make the logical stop, Let's say, let me go back to here. What's a logical stop, you may ask? A logical stop is a stop that you place that makes sense based on where you enter the market. If I bought right here, my stop should be down here, below that candle. That's a 1 hour candle. I would never probably use that as an entry chart, but I'm just telling you on a 1 hour. If I'm trading long term and I'm swing trading, my entry is right here at 32. My stop should be at 18. So based on how big my stop is, so if I enter here, see this over here? Let's look at this one. If I enter here, my stop's probably going to be smaller. But here I got 32.18, that's 14. Here my entry should be 70, and my stop is 5. So meaning I can trade about 3 times as much contracts over here than over here. You understand? So you gotta look at it. You gotta look at it from the perspective. Okay, here I can trade probably 3 contracts. Here I can only probably trade 1 based on my stop, So basically I gotta figure out, okay, how am I gonna determine that? Now the stop, am I gonna have a hard stop in the market? Am I gonna have an actual order in the market? Am I gonna have an actual order in the market to get out? Or am I gonna just play it by ear? I'm just gonna have a mental stop or a hard stop. We gotta make those decisions. So sometimes you may not have a stop in the order in the market, but I'm gonna click close when it hit that. But sometimes what happens is the market moves so fast, you may go past where you wanted to get out. So it's always a good thing to have a hard stop in the market. Even if you have a mental stop, have a hard stop that I call that a catastrophic stop. I can have a stop even though my stop is really here, but I can have it in the order might be right down here. This is my emergency stop. Let's say I go and take a sip of water. This is my emergency stop. This is my real stop, my mental stop. I'm keeping that in my mind. I can even put an alert here and see how the market reacts over here. And an emergency stop is down here in case something really drastic happens. I don't need to lose my whole account. And then you have another thing to consider. Am I gonna have a target? Some people just trail their stop. Some people trade with no target. Some people trade with a target. There's pros and cons for both. Now we can break that down at another session. But there's both for both. All in, all out. Am I gonna take 2 contracts and be in with 2 and be out with the 2? Or am I gonna take 2 contracts, take half of the position off after 5 points maybe? If that's what my trade plan called for. And those targets, by the way, will be determined by the ATR. I'm just gonna be randomly say, hey, I want 5 points. No. So am I gonna go all in or all out, or am I gonna scale in? Some people say, hey, I'm gonna put 1 contract in the market, and if it goes for me or against me, I'm gonna put another contract. That's called scaling in. Add. Scaling out, this is what I just explained, when you take out 1 contract. You had 2, you started with 2, then you take out 1, and then you take out, now you take out another one, now you're at 0. Trailing, so am I going to trail my stop? What method I'm going to use to trail my stop? All those going to be part of, preference and your goal. And are you going to have a goal for the day? Talking about goals. Some people say, hey, let me see if I can make $500 today. Oh, having goal is good, but you got to keep in mind, you may not get to that goal. Because what happens is some people keep trading until they get to that goal. No, if it's not a $500 day, it's not a $500 day. Drawdown, you definitely have to have that for the day. That's the cutoff talked about earlier. You got to say, hey, no mass. You got to have a cutoff. You got to have a cutoff for the day. If that cutoff is 250, 500, 5,000, 20,000, whatever account you have to be trading. So you have to have a cutoff to say, hey, today's not a good day. I'm not looking at the market. I'm not in sync with the market. Typically losses, if you have a solid, not all losses, if you have a solid method of trading and you keep losing, that means you, the user of that method, is not optimally in sync with the market. So you got to be able to get in sync with the market. Something is a something is not going. So the losses usually tells your story. If you're not following your rules, if you're just taking profit early, you're moving your stop too early, you're closing the position, or you just got down in the position, then you get panicked. So all those things. I mean, if that happens, you're trading too big. That's a symptom that, hey, I'm trading too big. So remember, we took a short earlier. I'm gonna clear this so we can see what we're doing. So we took a short earlier at that area. We're down by 1 point. So that area is an area definitely of interest. So we'll see what happened with this. But this was just an example to show you. Very in advance, and I can already tell which area that may of interest. I don't know if it will be, but it may. So this is when you're gonna see a lot of volume trading in an area like this, because the price is gonna be stuck there for a while. So there'll be volume there. So, any questions so far for what we talked about today?
ETR, is that sort of like the as well?
I cannot hear you well. What you say?
The ETR,
Mm-hmm.
sure. Is that the
Fibonacci? No. The ATR just show you the average movement over a period of time.
okay. Okay.
Yeah.
Okay.
Like this. I have the ATR here. I have an ATR, I think it's 4. Over the last 12 minutes, the market has moved an average 2 points. That's the average move over the last 12 minutes, because this is a 3-minute bar. Let me go back to this is a 3-minute bar right here. Let's undo this. This is 3 minutes, and this is the 4 you see here is over the last 4 bars, which is over the last 12 minutes. This market has moved about 2 points. That means it's been ranging. It's not really moving too much because it's the afternoon. It's 2 o'clock. Most people are done trading right now, So that's just what the ATR said. So meaning, for me, having a 10, that's a good example here. Having a 10-point target is kind of unrealistic. Well, it should be about between 2 and 4. So I'm gonna put it right down here. Should be my target. My stop should be right above this. Okay, so my target should be right around here, and my stop should be right around above the zone. So that's a realistic target, and my stop is really properly placed, because if they break that zone, that means, hey, they might go higher.
Is that target? It's not on the analysis that should
Am I on speaker or?
Do you hear me?
Yeah, I hear you, but I hear you kind of far away. Okay. I just want to make sure I hear you clearly.
Okay, can you hear me now?
I hear you much better.
Okay. So what I was saying was, waiting for that price to hit the 44.39.50.
Yeah,
You're betting for the market to go down based upon the news that came out this morning, and based upon some previous sessions that the market was in a downtrend, right?
yes, and also that zone that he got in a few minutes ago. That's a zone that should serve as support at resistance. It's a supply zone, because when he got to that, he stuck at that zone here for a little bit before, and the market went down. So market does that all the time. It's gonna retest that same zone.
Wow.
That's a retest.
Okay.
And that's different reason. We're gonna go into that in detail. There's a different reason market retests the zone. Because there's some people in the market, they don't care if the market go up or down. All they're here for is to provide liquidity. That's a more advanced concept. But if I'm a liquidity provider and people sell over here, guess what? I had to buy. I had to buy from them. For them to sell to me, I have to buy it. So I just want to square up my position and go back to that zone again. Then I'm out of the market here. So the liquidity providers are buying on the way down. They're buying, and they square up the position. They don't usually lose money if they know what they're doing.
Oh, okay.
They got to go back in here. So here, there's a good chance we may see the market stuck in that zone. But right now, it's up about 1 point, and my target is what? About 4 points.
It's away.
That's it. If we don't have any more questions, we can end this. And I'm gonna end the recording, and I can look at your connection for you real quick.
Here's the thing too. I did sign up for the. You can enter.
Let's end the recording, because we don't want to make it bigger than.
Right. So I did sign up for the